Welcome back. Let's continue talk about some recession indicator. Okay. As we discussed in the previous video, we have two kind of the official methods to figure out a recession or identify a recession. But we found that these two methods are not really prompt, right? We have to wait oftentimes a half a year or even longer to figure out the economy has already stepped into a recession. So some recession indicator could help us with this, identifying a recession in a quicker way. Okay. Now, as you could imagine, based upon the definition or the way we figure out the value of the indicator, literally speaking, we could identify a recession only a month after it actually started. Okay? In other words, what I'm talking about here is if just in 1 month the economy all of a sudden lost a lot of jobs, so unemployment rate shoots up substantially, that will make even, when we take the 3-month average, but the average rate, it was still much higher than the minimum from the previous 12 months, right? So that would, just that single month substantially higher unemployment rate would help us define or identify the recession. Okay. For example, what we saw back in April 2020, because of the nationwide lockdown, the economy in that single month lost 20.5 million jobs. Okay, so unemployment rate, increased dramatically, right? So under that kind of the circumstances, then the some recession indicator would be really helpful. Okay, if we're talking about a regular economic recession, probably with this indicator, it will take like 2 or 3 months to figure out the economy is in a recession or not. Okay, in other words, if the unemployment rate goes up modestly, okay, so we probably have to wait 3 months. When we take that average, then we would find it's half a percentage point higher than the minimum. Okay. Even so, you probably already realize that this is still behind the start of the recession, right? As we said, the best case scenario is probably just 1 month, but oftentimes we have to wait 3 months or even longer. Okay. In other words, we're gonna see that this indicator is still not a forward-looking indicator. In other words, with the sum indicator, we still could not predict the recession is coming, right? We cannot do that. We still have to wait after the fact. Okay. Now, we might want to know, do we have kind of the forward-looking indicator? Yes, we do. Okay, this is so-called the inverted yield curve. Now, to be understand how this works, we have to explain what a yield curve is. Okay, a yield curve is a line that plots yields or interest rates of bonds having equal credit quantity but differing maturity dates. Now, the yield curve obviously is a finance term, so there are some jargons we need to clear up. The first one is the yields. Yields, loosely speaking, that means interest rates. Okay, so oftentimes, people just refer to the interest rates. Of the bonds having the equal credit quality, this simply means, when we look at the other characteristics or features of the bonds, it looks almost the same, okay, except for the maturity dates. So maturity dates means when this bond ends, okay, or this financial transaction ends. For example, if you are purchasing the treasury bonds, okay, and it shows it's 6-month treasury bonds, that means in 6 months, the Treasury Department is going to pay you back, okay? For example, if you spend $100 today purchasing that Treasury bonds, in 6 months, they're going to pay you $100, okay? And different maturity dates, that means, the Treasury bonds or bills, they have here as showed in this figure, the shortest period of the treasury bill is 3 months, okay, and then 6 months, 1 year, I believe this is, and 2 years, 3 years, 4 years, 5 years, all the way to 30 years, okay. So if you purchase a treasury bond, which is 30 years, that means you have to wait 30 years to get paid back. Of course, before that, you can still sell this bond to someone else. Okay? But if you choose to wait till the bond becomes mature, then you have to wait 30 years. Okay? Now, another financial principle here is when we figure out the interest rate. The interest rate means how much you get paid, okay, every year. Then the longer the maturity dates, the higher the interest rate should be. How so? Because the longer the maturity dates, for example, 30 years, that's a longer commitment, right? As we said, you can definitely sell it to somebody else, but if you choose not to do that, you have to wait 30 years to get your principal, that's your original amount of money you invested, back, right? You can get that back from the Treasury Department. So the longer you wait, the higher level of potential risk you bear, right? Who knows what's going to happen between now and 30 years later, right? So that's why you would get a higher pay, okay, as a compensation of the additional risk you are taking by holding the longer maturity date bond, okay? All right, so that's why you see here, the vertical axis is the interest rate or yield, okay? The horizontal axis is the borrowing period. Borrowing period, that's basically the maturity date, okay? And so as you can see that, when you just, purchase a 3-month treasury bill, that means you lend the money to Treasury Department for only 3 months, then the interest rate is slightly above 1.5%. Okay, and if you choose to purchase a 30-year bond, then the interest rate would be slightly above 3%. Okay, and again, this is just simply the relationship between the risk you take and the return you will receive. Okay, so the higher the risk, the higher the return. Easy like that. Okay, it's a trade-off. All right. But interestingly, we find that in our history, the economic history, sometimes the curve would be inverted. In other words, what we observe on the bond market is the short-term bonds would offer a higher interest rate than the long-term bonds. For example, just hypothetically, if you purchase a 1-year, let's say, treasury bonds, it offers 3.5% interest rate. In contrast, if you choose a 30-year treasury bond, it offers here like 3.2%. So the short-term bond offers a higher yield than the long-term bonds. Okay, this is definitely counterintuitive. This means something is not right on the bonds market, right? So here, I would suggest you to go to Fred and find the chart of the inverted yield curve. Okay, so you try, whatever way you can come up with and see if you can find in the Fred there's any inverted yield curve. Okay, and then based upon the yield curve you find, do you see our economy right now is stepping into a recession or not? Also, look at the historical recessions and see how predictive or how accurate the yield curve is in terms of predicting the upcoming uh, recessions. Okay, now bring your thoughts and observations to class. We're going to discuss that. Okay. Now here, obviously, this yield curve, we're going to say it's a forward-looking indicator, okay? But it also crippled with some problems, okay? So what could be the problems? Again, think about this. And the answers should be based upon the observations we just mentioned, okay? Again, bring your thoughts, your observations to the class, and we're going to talk about it. Other than the recognition lag, we have several other lags we're going to talk about here. So after the economists figure out, the economy has already stepped into a recession, then they are going to pass their judgment to the legislators. Okay, so the Congress will decide, what they want to do here. Okay, in other words, how much time here it will take to be approved by the Congress. Okay, like the stimulus packages, for example. Okay. Now here, some examples in our recent history. American Recovery and Reinvestment Act of 2009. This is the Congress response to the Great Recession of 2007-2008. Okay. Now we find that this stimulus package or this act was first proposed in January 26, 2009, and it was later signed into law by President Obama on the 17th of February 2009. In other words, it took approximately 3 weeks, okay, for the Congress to get this approved, which is fairly fast, we would say, right? Given that, this act involves like hundreds of billions of dollars, right? A lot of details as well, and they only took 3 weeks. More recently, as a response to the COVID, the Congress passed the American Rescue Plan Act of 2021. Okay, this act was first proposed in the House of Representatives on the 14th of January 2021, and later signed into law by President Biden on the 11th of March 2021. In other words, this time it took a little longer for the Congress to pass the law, pass this act. Okay, it took them like literally 2 months to get this passed. Okay. Once again, even compared to some other acts the Congress passed, this is a fairly short period of time, right? However, when the economy steps into a recession, every day counts. Okay, because if we wanna, as we said before, we wanna fix it. We wanna fix it as quickly as possible before it causes more damages to the economy, right? So that's a legislative lags. We also have the implementing lags. That means how much time it takes to be implemented. For example, if the Congress passed the act, then how much time it will take the IRS to send the stimulus checks to households, right? Also, we have the effectiveness lag. In other words, how much time it takes to actually affect the economy, okay? For example, as we said before, the multiplier effect will take a lot of time.